Welcome to today's presentation on the state of Azzad Asset Management. We're using this opportunity today to give our clients and friends the chance to see how we're doing as a firm, in addition to offering updates on the markets and our work overall. I'm Joshua Brockwell, Investment Communications Director here at Azzad, and I'll be your host for today. Today we'll look at 4 key issue areas. First up, Azzad updates, last year up through today. Second, what drove market performance in 2022? Third, where we are now. And fourth, next steps. For those of you who may need a refresher, here's a look at who we are. We're an investment advisory firm established back in 1997 with approximately $1.2 billion in assets as of this recording, offering halal financial planning services for our clients. As I just mentioned, we are a full-service financial planning advisory firm. Here's an overview of the services we provide, from investment planning to tax and charitable planning to halal financial services. We've positioned ourselves as the leading provider of halal financial services in the United States. 2022 was another year of awards and recognition for our firm, which also celebrated 25 years in business, by the way. The year marked our first time being named to the CNBC Financial Advisor 100 list, and it was also another year of being named to the Financial Advisor magazine RIA ranking. The awards keep piling up. We don't do it for the recognition, of course, but it's nice when people notice your hard work for clients. Moving on, a quick update on one of our value-added services, shareholder advocacy. Azzad engages in shareholder advocacy on behalf of our clients. That includes proxy voting, filing resolutions, and engagement with corporate management. Some of our recent advocacy efforts are shown here on your screen now. We're particularly proud of our work with Chevron over the last several years on Myanmar and the ethnic cleansing of the Rohingya minority in that country. Chevron, up until last year, I should note, was the largest U.S. company operating in Myanmar, where crimes against humanity had been taking place at the hands of the military regime there. Thanks to efforts by Azzad and a large coalition of shareholders, Chevron announced last year that they were leaving the country. In addition, we also secured a sizable contribution for the Rohingya refugees in Bangladesh. This year, we're continuing to work with our partners in the faith-based and socially responsible investor community to take action against companies that cooperate with China and its oppression of the Uyghur Muslim community in East Turkestan, or Western China. For example, Apple is a company we focused on for 2 years now, after reporting showed that the company was censoring apps like the Quran and Bible in the Chinese App Store. We're pleased to announce that earlier this year, Apple agreed to our proposal to disclose which apps it takes down at the government's request, and also the legal basis for doing so. This is a big step toward greater transparency and accountability, because prior to this agreement with investors, Apple disclosed virtually none of this information. Switching gears now to investing and how we're putting client assets to work for them, let's move on to the portfolio allocation changes Azzad is making this year. For large company stocks, we're continuing to allocate slightly more to value than growth, as large growth stocks, even after 2022, remain near historic averages. We are very slightly increasing our small cap allocations because valuations are extremely attractive with small cap stocks. They were beaten up badly last year relative to large caps. Small caps also tend to rebound faster than large caps after market bottoms. We're maintaining our international positions in all 5 asset allocation strategies. While valuations are attractive compared to domestic stocks, geopolitical risk compels us to hold our position there. Now, if you're a client, you may be wondering if you need to do anything at all with this information. If you're in a non-taxable account subscribed to one of our 5 asset allocations, you don't need to do anything unless your financial situation has changed. If you've moved closer to retirement or a possible job loss, please reach out to your advisor. It may be time to reassess your asset allocation. Otherwise, we will be rebalancing your non-taxable account before the end of this month. A few of our clients may have gotten carried away and may be outside their appropriate asset allocations, or perhaps they're unsure which asset allocation is right for them. In that case, please reach out to your advisor if that's you. Sometimes clients have their accounts with multiple advisors, I should mention, and that poses a risk in that we can't analyze your entire financial picture. You may end up consequently being far more aggressive or conservative than you should be. Remember, one part of our value proposition at Azzad includes asset allocation and rebalancing. So how do we produce the asset allocation breakdowns in our 5 models? Remember, those are the aggressive, moderate conservative, and conservative allocations we offer clients. The way we do that is we fix the percentage of the individual portfolios you saw on that previous slide into each allocation. And we do that by determining the capital market assumptions, simulating returns, and optimizing portfolios for risk and return for our clients. We do this with our investment consultants at Fiduciant Advisors using a proprietary asset allocation program called the Frontier Engine. This analysis is typically done annually, but more frequently whenever market conditions warrant. It's based on 10-year forward capital market assumptions, so there can be slight changes depending on economic conditions. And to be clear, it's not trying to guess which asset class is going to outperform in a given year. Looking at 2023, the Frontier Engine's capital market forecasts increased across all asset classes, most materially in fixed income, given the change in yields over 2022. So what does that mean for you? This means that fixed income investors should finally start getting rewarded for taking less risk. This holds true for halal investors as well. Of course, we use the Azzad Capital Fund as a proxy for the fixed income component of our asset allocation models. As a reminder, that fund is a short-term, high-quality fixed income fund intended to provide investors with capital preservation. And you can download that prospectus from our website, azzadasset.com. Yields across many fixed income sectors are multiple times higher from year in 2021, producing greater opportunity for meaningfully higher returns in the years to come. Owning halal fixed income, we would argue, is now far more compelling than it was in 2022, and it may even add greater portfolio resiliency going forward. The Azzad Capital Fund portfolio management team at Federated Hermes expects the fund to continue to return higher than average yields given the fund's allocation and current macroeconomic conditions. And speaking of macroeconomic conditions, let's now take a look back at Wall Street's analysts' initial predictions for the stock market's performance in 2022 and how stocks actually performed in 2022, and also some of the factors that drove that performance. So as you see on your screen there, the S&P closed at 3839.50 at the end of 2022. That's a decline of 19.44%, and that was well short of even the least optimistic expectations of most Wall Street analysts. Few, if any, major financial firms anticipated the market's sharp drop from its historic high, which was posted on the first trading day of 2022, incidentally. It was a year of many surprises that forecasters simply did not anticipate. Two prominent examples of this were the Russian invasion of Ukraine and the unprecedented series of sharp interest rate hikes undertaken by the Fed. As you may recall, in 2021, the Fed suggested that inflation was transitory. Markets managed to cut some of the worst losses with a modest fourth quarter rebound, but it was a difficult year, unquestionably, for investors in both the stock and bond markets. Let's talk about some of the factors that led to this. As the chart on your screen now shows, you see a nearly year-long decline in stocks, as represented by the S&P 500 index, until a modest recovery in that fourth quarter. There's a saying on Wall Street, don't fight the Fed, which has never been more true than in 2022. Higher interest rates led to lower stock valuations as the Fed turned to a monetary tightening policy. So let's review some of the overarching themes that drove stock performance last year. Without going through each of these dates, as you can see from our first data point in January, inflation was already reaching levels not seen in many years. Inflation would accelerate from here and peak at 40-plus year record highs by mid-year before moderating, though remaining at historically high levels. In response, the Fed undertook an extraordinary series of steps to combat inflation, including raising its federal funds rate from near zero to over 4% in under a year. Matters were made worse, of course, by Russia's invasion of Ukraine in February, which, in addition to the terrible human suffering and loss of life it caused, created supply chain problems that led to higher food and fuel prices, which exacerbated the growing inflation pressures that were evident before that invasion. Recession was a major worry for investors all year, as GDP growth, which was 6.9% in the fourth quarter of 2021, fell for two successive quarters before rebounding a bit in that third quarter. Stocks mounted a recovery in the fourth quarter as investors began to believe that peak inflation and the bulk of rate hikes were behind them, and any recession in 2023 would not be as deep or prolonged as earlier feared. This late year rebound, however, stalled as recession concerns returned to the market in December. Corporate earnings are one of the factors that drive stock prices over the long term, one of the major ones, in fact. As the chart shows on your screen right now, the earnings growth for the S&P 500 companies decelerated in 2022, though some analysts believe that they may trend higher in the second half of 2023. The S&P 500 Composite Index, I should mention, is an index of the 500 largest publicly traded companies in the United States, and it is unmanaged. You cannot invest directly in an index. So let's take a closer look at what we're talking about. American businesses came roaring back from the pandemic, posting strong earnings growth in 2021 as consumers, helped by multiple stimulus payments from the government, went on a spending spree as that economy reopened. The earnings growth rate also benefited from a favorable year-over-year comparative period. Earnings in 2020, of course, were lower due to a national economic shutdown. Ironically, the 2022 earnings results were hurt by the comparison to 2021 surge in earnings, but that wasn't the only reason for a slowing growth rate. Inflation squeezed profit margins while consumers were left with less discretionary income after paying for higher priced food and energy costs. So we've looked at some of the factors affecting market performance in 2022. Now let's look at where we are now and examine the headwinds and tailwinds that could affect the direction of economic growth and financial markets in 2023. Here's a look at various economic and financial indicators that market analysts use to project future prospects. As you can see, there are no green or positive indicators on your screen right now. This stands in sharp contrast to a year ago when we saw 17 green indicators. Last year there were no red indicators. Today there are 7. Monetary policy remains tight, inflation remains elevated, and higher interest rates are dragging down the housing market. In a nutshell, the near-term economic prospects appear tepid at best, and if a recession develops in the first half of 2023, the depth and duration of it may turn on whether the Fed eases up on rate hikes. The labor market continues to be resilient, and consumer spending holds firm. It's clear that the 2023 economy may face some challenges. The first headwind facing the markets is inflation and those rising bond yields. Both can hurt businesses. Inflation can make consumers less likely to spend on certain items, while higher bond yields increase business investment costs, reducing profits. Inflation remains above the Fed's target of 2%. But the good news is inflation trended lower in the fourth quarter. If it continues its downward trend, it may give the Fed room to ease up on the size and pace of future interest rate hikes. That leads us to our next potential market headwind, which is recession, on your screen there. As the Fed tightened monetary policy, the drumbeat of recession fears increased. Finally, geopolitical tensions are a potential headwind as well. Headline examples include the ongoing conflict between Ukraine and Russia, as well as China's threats toward Taiwan. But it's worth remembering that it's often the geopolitical event that no one anticipated that surprises markets. While the headwinds facing stocks are not to be underestimated, there are several potential tailwinds that may actually support financial markets in 2023. In the final months of 2022, consumer prices increased. Those consumer price increases started trending lower, though. Falling inflation may boost consumer spending, which in turn could help corporate profits. Moderating inflation, as I just mentioned, may also give the Fed room to ease up or even pause on those interest rate hikes in the year ahead. While inflation remains above the Fed's 2% target, fresh evidence of a downward trend may set the stage for a more dovish monetary policy. One result of higher interest rates in 2022 was a rally in the U.S. dollar. A stronger U.S. dollar hurt some multinational companies that generate part of their revenue overseas. Should that dollar weaken in 2023, it may help the bottom line for some companies. The cycle of higher interest rates may be closer to the end than the beginning, which is another tailwind. This would be welcome news to the financial markets. Finally, some will keep watching China, the world's second largest economy. With China's exit from its zero COVID lockdown policy, a more open China may herald a return to greater reliability to the global supply chains and reinvigorated demand from Chinese consumers, which may provide a welcome boost to global economies. So what are major financial firms forecasting for domestic stock prices in 2023? After a difficult year, forecasters are a bit downbeat about the prospects for this year. As you can see, some firms are projecting a year-end close on the S&P not far from the market's 2022 close of 38.39. Of course, no one knows for sure what equities will do in 2023, and predictions at this stage are just that, predictions. Like other images in this presentation, this image includes a forecast, so it's important to remember that forecasts are based on assumptions and are subject to revisions over time. We've covered a lot of information today, focusing most of our discussion on what drove the market and what we expect to move the market over a short period. As this chart shows, the performance of a hypothetical 60% equity and 40% bond portfolio was down through the first 3 quarters of last year, with negative returns for both stocks and bonds. Our chart starts in 1977, and as you can see, it was the first time that both asset classes had losses. So, what can you do in 2023 to move closer to your goals? Here are some action items for you today. If your life or personal situation changes, keep us in the loop. We want to hear about important family events like births and unfortunate deaths. We also care about health issues, employment changes, and any financial developments that may change your situation. And if you find yourself thinking about new goals or reevaluating your priorities, share your thoughts with us so we can help you pursue the life that you most desire. On top of specific adjustments in your financial life, we also want to know how you feel about investment changes. These could be details like a risk tolerance shift or any market environment concerns. And finally, remember to review your estate documents, beneficiary designations, and other paperwork to ensure they're all up to date. A well-organized estate is one of the best gifts that you can give to your family. We're here to discuss any financial questions or worries you may have. Our priority is always to help you make informed choices and to stay on track. Throughout 2023, we will focus on delivering the following at Azzad. First, we'll keep you informed through regular communication of market goings-on. We'll manage your investments according to your personalized strategy, and we'll remain abreast of economic factors and adjust accordingly. Thanks so much for your time today. As you can tell, we at Azzad are passionate about helping you understand the markets. And for more information and timely updates, please follow us on social media and visit us at azzadasset.com. We hope that you enjoyed today's presentation, and thanks again for watching.